Hello and welcome to Fireside with VC. My name is Andrew Romans, and I'm very excited to have Charles Hudson on the podcast today. Charles is the founder and managing director of Precursor Ventures. He actually is a double Stanford guy, I think BA and MBA at Stanford. And then I think very interesting start to his career, worked with George Hoyam at In-Q-Tel, which is a super cool strategic kind of CVC that originally represented the CIA and now has all these different kind of spook military clients, which are really the LPs, which I think is just a tremendous thing. And then he worked for one of my other favorite people, Jeff Clavier, at SoftTech VC, which changed the name to Uncork Capital. I don't know. I kind of always like SoftTech as the name. I think of Jeff as sort of, and I guess you as the original emerging managers. So like breaking away from the old dynasty of the 80s and the 90s fund. So real entrepreneur, funpreneur vibe before starting Precursor. So Charles, thanks for coming on the podcast.
Thank you so much for having me.
Yeah. So we're going to get into a really cool conversation. We're going to talk about AI and what it means to founders and investors in the whole world and other things and emerging managers. But first, quick word from my buddy, Mark Titirjani at Pacific Western Bank, who's sponsoring the podcast.
Hi, everybody. This is Mark Titirjani. I'm with Pacific Western Bank, and we are a bank focused on helping startups grow and get to the next stage. We've been working with Andrew and 7BC for years now. Andrew and I go back a decade and a half at this point, and I've always respected the fact that he's a thought leader in the space and somebody that you can learn an awful lot. And he kind of opens up that window a little bit into VC and what's happening in the back room. So we're excited to be partnering with Andrew on his podcast here at Pacific Western Bank. We focus on helping startups get to the next level. We offer a startup services program for companies that are the pre-A, which includes some free banking and some high yield interest rates. And then when companies raise an A round, then we start moving into treasury management services and then venture debt. And we believe that we're one of the leaders in the venture debt market because we are flexible and we can do custom packages and we don't just do off the shelf type of term sheets. So enjoy the podcast. It's going to be a lot of fun. You're going to learn some things and we'll see you on the other side.
Thanks, Mark. And anybody who needs an introduction, happy to share your information with them. Just get in touch with me and I'll put you in touch with Mark. Thanks so much for supporting and sponsoring the pod. So Charles, I want to talk, actually, I'm kind of excited to talk about the AI stuff, but give us a quick tour of, I guess you worked at like Cisco and a couple places before In-Q-Tel, but maybe tell me the start of your career and your journey.
Yeah.
How you got to where you are now.
In-Q-Tel was my first job out of school. So I went right into venture. It was a crazy time. In-Q-Tel was still very much, in my mind, a work in process when I was there. And there was a real focus on trying to help the CIA in particular get better connected to all of the emerging technology that was happening. And this, for those who don't know the full story, this is back kind of think the early 2000s. This is kind of the beginnings of cloud, the beginnings of kind of the consumer internet. There was all this innovation. And back then, this is kind of also pre-Palantir and pre-Anduril, before there were startups that were venture-backed that really courted the government as a customer. And the idea was to try to help smooth out that interface and help the elephant dance with the mouse, so to speak. It was a really, really fun job. I really enjoyed it. Left there, went to business school, had a handful of startup experiences, some where I was on a management team, some where I was the founder, and just really fell in love with startups and realized that startups were a better fit for me, skills and experience-wise, than big companies were. And made the decision that that was going to be my career for the future. And then around 2010, reconnected with Jeff Clavier. I actually had met him when he was working for Reuters Greenhouse Fund.
Oh yeah, that was John May. Or, in London, I had a term sheet from them. What was the guy's name? John Taysom?
There were three or four.
I think there was John
three or four
Taysom.
guys.
Yeah. I ended up moving to London, but yeah, John Taysom from RB and Nick Brisbourne was working there.
Yep, Nick. Yep.
Yeah. Those great people. Yeah.
Good group of people. And so it was super fun. And Jeff was really looking to take what was then SoftTech from a firm that lived in his inbox to a firm that now have 5 partners over there, and a whole team and a lot more AUM than they had when I was there. And for me, the big aha was when I was at Uncork, it felt like there were 5 or 10 micro VC firms, and we all co-invested, whether it was Mike over at Mike Maples over at Floodgate, or it was the Felicis team. There was just a really small group of people, Michael Deering, Manu Kumar. There just weren't that many people running these funds because I think most LPs didn't think they were terribly viable. And now all of those people have been super successful. And even that back then, True was a relatively small fund, and all of them have scaled. And
by the
really
way,
kind of changed seed.
So with the AUM shift for Jeff, it really changed the strategy. Like I think Mike Maple said, your fund size is your strategy. Mm-hmm. And I think those are wise words that ring for me. But what was the strategy when you were originally there? You were writing kind of small, earlier checks than what Uncork has evolved to, right?
I would say when I was there, and I'm not there anymore. I have pretty good insight, but not perfect information. When I was there in the beginning, we were doing what we called seed investing, but today would be pre-seed. These were like $1 million rounds where we wrote a 500 to 750K check. And we were sort of a pretty big chunk, but the prices were low and like our ownership was pretty good. And the funds were small enough that, selection was really the name of the game. As the funds got bigger, ownership became a much bigger piece of the puzzle. And fund size went up, portfolio size in terms of companies went down, and ownership and resources per company went up, if that makes sense.
What were pre-money valuations for pre-revenue companies back in the day here? And what years?
They're like what pre-seeds are today, like 5, 6, 7.
Yeah. Okay. And so to fast forward, I mean, I think you rose up at SoftTech to general partner, right?
Yeah, so I came in as a venture partner, kind of off cycle, and started as a general partner in the next fund.
Okay, and were you helping raise LP capital? Did you have?
Jeff did the fundraising. I mean, the nice thing about joining a solo GP is that person has worked out how to do everything before you've showed up. And so I maybe contributed to a couple of our fundraisers, but Jeff was the dominant force in raising those funds.
And what were the cross section of LPs? Were they individuals, high net worths? Was he cracking institutional capital in those days?
Yeah. When I got there, when we did Fund 3, we for the first time had that fund, we went from 15 in 2 to 55 in 3. And there were some pretty chunky LP checks in there from institutions. And it was different. I think the previous funds had a very concentrated LP base with one person who provided a significant chunk of the capital. And as we move to more institutional, again, it might be hard for people to imagine this. In 2011, there were still a lot of LPs who were not sure that seed investing was a good business to be in, or that it was a business at all. And there was significant LP skepticism, at least I saw, that the seed as an asset class and sub-asset class of venture was a thing. They're like, maybe there's just like a very small handful of people who are good at this, like super. Remember, they all used to be super angels before they became micro VCs.
Yeah,
and it's been very interesting for me to watch how that evolution has gone from seed is not a thing to seed is a thing to now seed is overfunded, according to some LPs, and that happened in a 10-year cycle.
Yeah, I mean, I kind of think Ron Conway was the trailblazer of investing a lot. I remember Morten Lund was this buddy of mine that had lent money to Jonas Fritz, who is Nicholas Zenstrom's co-founder. Mm-hmm. And then he was like, dude, I'm broke. I need the money back. And he's like, I'm broke too, but I'll give you some Skype shares. Yep. And then those Skype shares turned into just life-changing generational wealth. Mm-hmm. And then Morten went out and he's in Copenhagen, invested in 65 companies in a year. And I remember thinking, this is very, very stupid. And then over time, and I got to know Ron Conway better before like Topher came on, and he was showing me the spreadsheet of all of his investments.
Yep.
And he was like, you really want to get to like 250 in a vintage, because then you've really neutralized any of the singular investment risk. But I think that it was probably hard. It was kind of hard for me to understand what Morton was doing there, like who invests in 65 companies, how you're supposed to add value. But so what were portfolio sizes before the shift of the fund with AUM and getting more concentrated?
We went from like 60, 65 to maybe more like 40, 45. I have to double check my numbers, but that's what it felt like.
Yeah.
And we had more people. So it was also fewer investments per person.
Right. Okay. And so fast forward to now, what was it, like 2014, or when did you get cracking?
2014. Yeah, I
with
started
Precursor?
April 1st, 2014.
April 1st. Okay.
April Fool's Day.
Right. And so how did that come about? Did you have an anchor LP before, or did you just jump into an empty swimming pool there?
A couple of things. I knew I couldn't really raise a fund while I still had a full-time venture job. I just didn't think LPs would take me seriously. I had this gnawing idea that like there was still money to be made in the old model that we had, which was more companies per unit of time, lower valuation, higher risk. And I felt like there was money to be made there because all the people who'd made money there had moved on to
Wait,
something.
say that again. Let's make sure I catch it. You're basically talking about a strategy.
Yeah, I felt like what we used to do, which was 60, 65 companies per fund, low entry price, not these like super famous high pedigree founders. I was like, there's still money to be made there. It's just like we don't have any interest in that subcategory, kind of because we don't have to. Like the opportunity set for us is much greater now at Uncork. And I was like, but I think there's still tons of founders down there in that bucket that like we could be really successful in working with. And I was like, I think we're going to do 60, 65 companies. Turns out we've done more than that per fund. And I was like, I think if we keep prices low, we should be fine. And this was a incredibly unpopular pitch, Andrew. Like, no, I pitched a bunch of people and they're like, all you're going to get is adverse selection. It's too many, to your point, it's too many companies for you to even know by name, let alone add value. But you mentioned Ron Conway. A lot of SV Angel is like a inspiration for Precursor and stuff. And I've told Ron this before. Just, there's certain things I think they do. I know a lot of people who've taken money from SV Angel who can tell you some epic hero story about one thing that Ron Conway did for their company that changed the trajectory of the company. Not 100, but one. And one is a lot if it's the right one thing.
Yeah, sure. If it impacts the exit or I mean, I like to think like I call ourselves like a network driven VC. So a lot of the LPs are actually just do one thing, once. And that is, bringing in an orthogonal network or just something.
Yeah.
As opposed to us who hang out with the same people all the time, can make a big change. So it's been quite a few years for you now.
Yeah.
So has your strategy changed the way SoftTech, or are you basically practicing the same strategy that you initially came out with?
We do 80 to 100 companies per fund.
80 to 100. And what is that? 2-3 year period?
And about a 2-year commitment period for new deals.
Okay.
It remains unpopular, and it's solo GP. It remains unpopular with LPs.
Okay. So sole GP.
Yep.
Did you say 60 to 80?
80 to 100 companies per fund.
Sorry, 80 to 100,
Yep.
80 to 100. And so like how many a year, how many a month, or how do you view your investment pace?
Yeah. I used to try to keep myself to something that felt like a consistent pace. And what I realized is that I would just see interesting companies in bunches.
Yeah, that's what reality is like, right?
Its reality is that it's bunches. I can tell you the max I did in a year was 71. Jeez. The min was probably 30. 50 is about where we should be.
Can you imagine getting a job at Lightspeed where there's 6 or 8 of you and you each make 2 investments a year, right? And of course the LPs love hearing this.
Mhm.
But that would just be such a different intellectual brain
It is.
situation to it sounds like being in a horrible marriage or something to me.
I have friends at big funds, and it's like I think I'd be done by Martin Luther King Day for the year, and I would have to take the next like 11 and a half months off because I would have found my two companies, and I'd be done for the rest of the year.
Yeah, that's what
And
4.5 months of vacation a year looks like. It's just crazy. So
yeah, it's a different skill set.
okay, so 80 to 100 in a year,
No,
and
per fund, to be good. Per
sorry,
fund.
per fund.
Yeah. Mhm.
And you're maybe 2.5, 3 years in a vintage, roughly.
Mhm.
And what stage are you? What's your Goldilocks stage, or what's the range of stage for the company that you're going into?
It's mostly pre-product market fit, pre-launch, two founders, really solid, well considered, well thought out idea.
And for now, what is roughly check size?
500 plus or minus 250. So in most cases, our check alone is enough to get the people going and to get in business. And that's the goal. Is that our check should allow them to get in business and get going, even if nobody else shows up, which happens sometimes.
Okay, so this is real pre-seed. And what do you have a follow-on strategy?
We've tried everything. We've done AngelList SPVs, we've done non-AngelList SPVs, we've done opportunity fund, we've done bigger fund with more crossover. I've kind of landed on bigger fund with more crossover just because it's a single decision for our LPs. And
okay, so if you invest in, you have an entry point that is pre-product kind of fit stage, and then what percentage of the fund would be following on?
yeah, it's there's all these other math problems you run into with a big portfolio, which is when you have 100 companies, the difference between 55% graduation and 50% graduation could be $1 million, $1.5 million in follow-on that you need to come up with in either direction, or you don't need to deploy. So we've always been somewhere between 80-20 on the most extreme first check to follow on to maybe 60-40. I don't think we'll be 50-50 or anything like that. Principally because every follow-on check we write competes with the ability to invest in a company at, let's call it 6 post.
Yeah.
And I'm like, instead of investing in this Series A, which I believe in, I could write a new check to a brand new company at an incredibly low entry price, and that could be the one that returns the whole fund. So there is this tension between our entry price being really attractive on an absolute basis and the ability to concentrate dollars in the companies that are really winning.
And what do you have a preference for price rounds? Do you manage to like get these things in as price rounds, or are you unfortunately doing safes, or maybe you love safes? I don't know. I kind of would almost always rather be. I mean, I like to get credit for QSBS. You know what I mean?
Yep. I hear you. I have a preference for price rounds, and the market seems to have a preference for safes. And for us, it has all kinds of other downstream effects. Even for our performance reporting, we have sometimes companies that raise 3 safes in a row.
Yeah, that's annoying. And when one of the nice thing about a price round is that you get major investor rights and you get a pro rata equity right, whereas on some of these safes, you didn't convert into preferred, and so they can raise money and not even tell you, as opposed to give you the right. Now it's our fault if we're not talking to them every time you jump in your car, and and so that what's going on. But I want to get a lawyer from a major firm on the podcast and say, stop this safe nonsense. Like what's with a $15 million round that can't pay the lawyer? And shouldn't that just be a web form to fill in anyway? I mean,
we've just had, and I think the safe is great for efficiency. 1 safe is usually not a problem. 2 safes is sometimes a problem. In my experience, 3 safes is always a problem. And the number of cap tables I've seen, or when all the safes finally convert, and the founder sees what they own, they're like, well, somebody made a mistake with the math. I'm like, no, that's just like how the conversion math works out. Plus, you're going to get an option pool top up because of the price round. And it's just, I'm like, I think you would have felt really differently about this had you had to take that dilution in chunks along the way, instead of kind of pushing it off to this one big conversion event.
And I think sometimes the investor, at least early in my career, I was like, what? How did I convert at a 25 million pre when it was an 8 million cap? And then they drop an ESOP, the employee option pool gets dropped on. Basically, like before we were recording today, I was talking to you about that story, which we can't talk about publicly, where the denominator for once got smaller when a founder is basically going to prison. Whereas normally that denominator of the total outstanding shares on a fully diluted basis can just get bigger and bigger and bigger. While the amount of cash is the numerator, and that's your fractional ownership. It's a little upsetting. All right, that's cool. And Charles, I think of you as a kind of generalist software, kind of true to the old SoftTech.
Yeah.
What's your investment thesis in general?
It's like 2/3 people, 1/3 market. I told one of my LPs, I actively try to remain generalist. I think sometimes you get these big waves and there's the temptation to like go all in on generative AI or go all in on Web3 or go all in on crypto. I'm basically just trying to pick the very best founders that I meet, subject to them working on what I consider reasonable ideas, knowing that they'll pivot some and they'll learn some new things. But I go into it assuming that the idea matters, because with $1 million, you don't actually have that much room and space to pivot. If you raise $5 million, I actually care a little bit less about the idea, because you have the money and time to try several things if the first thing isn't great and you have an exceptional team.
So, I mean, in a world of pivots, what you're left with is the management, and maybe the market that they're born to disrupt or attack. So what is the total financing round for these companies? If you guys are doing your check of 250, 500, 750K, what's the total size of the round of the financing that you're participating in?
Ideally $1 million. Excuse me. Ideally $1 million. Ideally, the company's going to get 12 to 18 months with that. And I think that's enough time, because I really want them focused on product market fit finding.
Yeah. What often pushes us at 7BC out of the round is that the runway was too short for our liking. Like we tend to say we like a minimum 18-month runway so that you can kind of test the thesis of this Bunsen burner science experiment. Does this work or not? And then after 12 months, you still have 6 months in the bank to be able to calmly run a fundraising process to not go to zero. Whereas if it's a 12-month runway for me, it's a little spicy. It's spicy because it's like it won't be very long before we're not company building, we're back out fundraising, for the startup, that I get concerned. But they don't want to sell too much stock while it's so cheap. So it ends up being a shorter runway, and someone like you gets into that deal, and we get kind of, in my view, pushed out from our own policy of seeking a longer runway. And when the economy goes down, I kind of want to see it get a little closer to 24, but that's hard to get.
Yeah, and I think for me, I'm very comfortable writing a second check to a company midstream if I think it's going well, and we'll do that a lot. I kind of have the opposite ethos almost, which is like I want people to very quickly figure out if they're onto something, and if we compress the time frame, you're not thinking of like you're focused only on finding product market fit. You're not really focused actually on like company building per se. It's really a product market fit finding exercise. And if directionally I feel like you're heading in the right direction, I'm totally fine to write another check.
That's probably really smart. Like LPs don't understand you probably. They don't understand the single JP, the whole thing. But from my perspective, like if it were my money going to your fund, like if it's my personal family money going into Precursor and you're running it, I'm actually pretty psyched if I see you write a mid-off cycle check into one of your portfolio companies because you're getting some good information that,
Yep.
and they're like, I'll take Charles's money because he's good people and we already know what it's like to deal with him. Those are probably some of the best investing ever, that you're just getting some ownership of an asset as opposed to everyone join in line, pull the lever, and it's a big series A or B
Yeah.
round. That's kind of maybe where like returns are really being born and coming from, I would imagine. But it's
We think
it's hard
so.
to pitch that to like an endowment, right?
Most of what we do is hard for people to understand. And it's just, there's not a lot of funds that invest the way we do. And, consensus is concentrated ownership, relatively small number of positions per fund, high GP engagement at the board level. Like that's the formula. And if you're going to be anti-formula, you just have to be okay with the fact that a lot of people are like, well, there's a formula that works. You're not following it. Either you're really onto something or you like are naive.
Well, at the end of the day, there's cash on cash returns and there's IRRs.
Yeah.
What do you with your model? What is the like failure rate? Like, I remember, and by the way, early on, I was like, gee, we're not failing enough. We're barely losing any bodies or soldiers on the
Yep.
beach here. And then give it some time.
Yep.
And our failure rate actually was almost a little bigger than I thought.
Mm-hmm.
Like I heard Hans Swindlin from Industry Ventures once say, if I meet a VC who's like beating his chest, Tarzan, proud of the fact that they lose fewer than 30%, I think they're not taking enough of a risk. I don't
Yeah.
want to invest. I don't
Yeah.
want to invest in the guy's fund. And I heard that and I was like, oh shit, I think that we're below 30%. And that dude's not going to cut a check into my fund. And then maybe we grew into 30%, over time, or what I would just be like, it's pointless Walking Dead.
Yeah.
What do you see as a failure rate? Because you're pretty early.
Yeah. And we've come through an era where everyone had low failure rates. I think for us at pre-seed, it's 40%, 50%, something around half.
Right.
And that feels healthy to me.
Yeah. And when and where that formula that the LPs are like, this looks and smells like benchmark, where like all these equal GPs, big team, and they make 2 investments a year and it's concentrated and they're squeezing the neck of the founder by being all up and on the board, right? But they're returning a 2x fund, and a 2.5 fund is considered good. But if you're split $1 billion fund that 2x's with 2 GPs, that's 200 million to carry, and do that every 3 years or 2 years. That they're happy, their LP is happy getting a 1.25x sometimes, and it is what it is. And if they're lucky, 2x. What multiples are you making on single companies by investing early?
We have, I know these are unrealized, but also like adjusted for today's environment. We can consistently find several companies of fund that are 100x cash on cash.
Right, 100x.
If you think about it, if you're investing at a 5 pre and you get to $1 billion and you assume 50% dilution, you can get to 100x.
Right. And
now we don't do that every time. I wish we did. We don't do that every time.
Yeah, but it happens where that doesn't happen for the guys that are coming in much later.
And I think I'd argue it's hard to do, even if you move the entry point from 5 to 10, it gets significantly harder on a cash on cash basis to get. Now you need probably $2.25 billion company.
Yeah, I remember
to do the same thing.
We were talking about investment pace, and sometimes it slows down. I remember in like the spring and the summer of 2021, and we do some seed and some pre-seed, but we kind of, our Goldilocks is like 100K MRR, because then our network can really, add to it. But I remember these founders saying, I was like, why is the valuation so high? If I have a 50% dilution, I got to sell for a lot more than AdMob and YouTube. And you don't really strike me as an AdMob or a YouTube, right? Like, and they would say, oh, I'm fully convinced this is going to be a multi-trillion-dollar company. Like, you really heard the word multi-trillion-dollar company for these guys to justify those insanely high entry points of that momentary lapse of reason in the market. So when you are early, it can be a long holding time period, and QSBS, actually the 5 years in a day, does come into play.
Yep.
and because we're that patient, do you guys ever sell something on the secondary market because
We
these
have,
valuations are up?
we have,
Tell me
with the
about your
benefit of
evolution of
hindsight,
thinking around that.
I've just basically redefined our secondary policy. I wish we'd had it on the way up. But we face this tension, which is, we're trying to deliver returns that are impressive on both an absolute and a relative scale. And on the way up, a lot of our late stage companies, I'm like, well, if I sell it today, there's a very high probability that in 1 quarter, this company is going to raise at double the valuation.
Right.
And that was happening. So I'm like, well, how do I sell into this kind of momentum? The answer is like a little at a time was the right answer. And we did that in some cases, but not nearly enough. We should have, with the benefit of hindsight, done more secondary selling. But I was trying to balance, absolute return and return relative to our peer cohort set. And I was like, well, I don't know that we can achieve the relative performance goals that I have if we're aggressive sellers of these companies in the secondary market. And now I'm just sort of like, at certain price thresholds, we're always going to try to sell something no matter what, just as a matter of principle.
Yeah, I think at some point it's unethical and rude to Jerry Maguire show me the money as opposed to wire me the money. Like these reports of like, hey, we were invested in this company at 8 million pre and it's now 2.5 billion and I've sold nothing.
Yeah.
And what happened with us was just we have a lot of kind of retail-y accredited investor LPs, like, a lot of, people that we know are LPs in our fund. And they are not vampires. They don't live forever. They're not, in, the Vatican pension fund kind of stuff. And so it's kind of useful to wire them some money so that they can either spend it how they want or they can re-up in your next fund.
And it feels good. Distributions feel good.
Yeah. And achieving a 1x DPI is like, I paid off my house.
Yep.
No more mortgage.
Yep.
This feels good. Like it feels good for everybody. So I think a little bit of secondary selling for an early stage fund that's achieving such up rounds does make sense. I mean, we do SPVs, so we allow people to continue to invest in the late stage.
Yep.
But we're selling like 5 to 25%. I've seen some seed guys sell 50% into some Andreessen Horowitz round, and I'm like, dude, that's too much. You shouldn't have sold 50% at this moment. And now that they're in, they're going to have some of their LPs invest in some dumb valuations that no one's heard of them. So and it's saying it's only 1 quarter away sounds a little like a crazy cycle, but they usually raise around once a year, and that could be 9 months from now, and it could be 18 months from now, but it's more likely to be around the 12-month.
Yeah, in 21 it was happening so fast.
That's right. Yeah, I mean, if 2021 had continued, we would be DPIing our.
We'd all be wealthy and retired.
Right. We'd retire.
Even the 51st percentile VC would be doing quite well in that environment.
Right. I was once sitting next to Bill Draper at a Lifetime Award HBS dinner for Pitch Johnson, and some guy was up there giving some keynote saying, "Are we in a bubble? Are we not in a bubble? Are we in a bubble? Are we not?" And Bill leans over and goes, "I don't care if we're in a bubble or not. I made a lot of money in a bubble, and I make a lot of money when the valuations come down. Either way, it's fine with me." I thought that was cool. So let's totally switch gears and talk about AI and generative AI as a wave. I mean, I read your blog post that was saying if there's really only kind of OpenAI has the Sam Altman solution, and then you with ChatGTP, and then you've got, and then so Microsoft is in with that, and then you've got Google kind of doing its thing. Kind of like I had a founder send me an email on her deal, and I've known of her company for many, many years, and she's sort of still coming back. And she goes, and let me remind you, we are not a layer on top of ChatGTP, OpenAI. We have our own natural language models and NLP of our own. What are your thoughts about kind of do we have like one company or just a very small group of companies dominating what is happening, and where is the value for an investor or founders?
I keep trying to figure this out, and I meet all these great companies, many of them here in San Francisco and Hayes Valley, and they show me these impressive applications using AI. And I say, how long did it take you to build this? And they say, it took us about 2 weeks. I was like, that's impressive. How long would it take an equally talented team? They're like, probably 2 weeks. So I'm like, okay, that's sort of the going answer for some of these things. It doesn't feel, and also to be clear, I'm not an infrastructure investor. I'm really an applications layer person. So I believe there is some really interesting work happening on the infra and tooling side. I just don't have the background to analyze or assess that stuff. So we tend to focus more on the application side. And I meet a lot of these companies and just sort of like, okay, so like there's 4 of you working on the same problem using the same underlying tech and tools. I don't get it. Like, I don't get how you build. I don't like this term. Moat is, I think, has become a term we've kind of like beaten to death. I'm like, I don't understand, like, what's your unique value?
It's relevant though. It's relevant. I mean, like, where, if the company is saying, come here and we'll make a logo for you, right? Like, we will make a logo for your product, your little product, or for the company itself, and you pay this much money, and that's basically a UX UI on top of Dolly or something. It's on top of an OpenAI product, and someone will, they have like unit economics of how much they have to spend to get somebody to go and buy the logo from them, and they're making it at 1/8 of the price. It'll quickly say, here's 10, choose one. But what's to stop 90 other companies that don't even require venture financing to launch exactly the same thing, and it becomes a race to zero and crowded, and TechCrunch doesn't know what to say about yet another?
That's my fear, is the race to the bottom. And then I look at something like Midjourney, I'm like, it's allegedly, like, it's under 15 people. And it's like pretty awesome. I love Midjourney. I play with it all the time. And I think like my venture brain is having a hard time figuring out, like, what do I do here?
Well, one thing I've been thinking about, so I also very quickly said I'm a little confused about having high conviction of putting money into a company and putting all of our network to support it, if it seemed like they made the product in 2 hours and anybody could do it as well. But then I kind of think, how cool is it that every engineer can check their code and be a 10x engineer, and like your bottom 20% of engineers are now like Bruce Lee beating up a million guys, as opposed to being the guy that Bruce Lee was beating up? And you kind of metaphor to how productive of an engineer they are. And then if you think of like some of the marketing people can, there's stuff that they wanted to do that they probably never got around to doing. Like, all right, I'm going to take this podcast, transcribe it into text, have it summarized, post it as a blog post, cut them up for shorts, break it, like stuff that is, I don't bother to do.
Yeah.
Someone could be a 10x, like, hire somebody right out of undergrad and have her producing 10x the amount of work and output as a result of it. So your check of $500K is all of a sudden doing like $5 million worth of work. And so fewer people. So it's like, someone could just say like, all right, so Stripe, it was $100 billion and now all of a sudden it's $50 billion company. How about somebody with a very low liquidation stack who doesn't raise a lot of money, says, I'm going to offer 90% of what they do for 10% of the price.
Yep.
And so maybe that is an opportunity for guys like you and me to identify companies that can be competitive with what required like biotech trainloads of money.
I think so. I think the other thing I'll say is the reason I remain excited it's not so much the new startups I'm meeting, it's like companies in our portfolio who've been experimenting with this are like, oh, we went into this experiment thinking we knew exactly where this technology could make a difference in our processes. And it turned out we were wrong. We thought it was going to help over here, but it actually helps over here in this other area. So the reason I am not willing to totally sit this out is at some point it will become clear. And I don't think I want to have 0 companies in the category.
Yeah.
When it's, the other thing is we have 280 active companies. We have some that have pivoted into this. So I tell my LPs, don't worry, whatever the new thing is, we're going to have exposure to it, even if I never commit $1, because we will have some portion of our portfolio that's existing that moves in this direction. So we will, for better or for worse, we will get exposure to whatever the new trend or theme is, except for things like synthetic bio or things that are like the world of other smart people.
Right. Yeah. I mean, it's sort of interesting that, all these, drugs are becoming software, but it's still not my area of expertise to go into. When I ran the Founders Club, which was the venture capital equity exchange fund, NEA was involved, and they asked us to create equity exchange funds for the biotech founders because they literally have all their eggs in one basket. And every time you go through like phase 1, 2, 3 clinical trials and even FDA approval, that's literally walking through a minefield, finding the mine and jumping up and down on it, seeing if you blow up or not, like total risk of binary failure. So for those guys to be diversified by swapping equity made a ton of sense. But everything I learned about that was like, it's all the character, like our framework of investing is for companies that do not have those characteristics.
Yeah.
And you can find them in the non-biotech world that have these total risk of binary failure, guaranteed to take a long time, no way to sell in the secondary market. But so we avoid that. But within your understanding of this emerging, rapidly changing world of generative AI, what are some kind of categories you're seeing? So we were kind of talking about the startup that has a layer on top of OpenAI that is able to offer something very quickly and cheaply, and that's kind of magical, jaw-dropping stuff. What are some other categories you're seeing, like data lakes or?
I mean, I think for us, because we are so application centric, most of what we see is application layer stuff. I've met some companies that are building tools for other companies that are building AI products, and I'm like, that sounds interesting to me, but I don't have a strong point of view about that market. I've met some people that are building kind of some performance related things to make these applications more efficient on the GPU CPU side, and like that's a little over my head, but seems like they're addressing what, especially with GPT-4, seems to be a pretty big compute problem.
That's right.
But we've really focused. I mean, the thing that's been surprising to me is the wide variety of domains in which we've seen and I think someone who I really respect was like, yeah, I just went back and looked at all these other ideas that before didn't work and said, like, does the existence of this technology change? Like, I'll just pick one domain. I think like legal tech has been a really sleepy domain for VCs outside of Clio. I think legal tech is going to become really, really, really interesting because it is a natural use case for this technology, for AI in general.
What's really weird is that you would think legal tech would just make so much sense because they had Martindale Hubbard before there was the internet. They had LexisNexis, which was like the French Minitel. Like you could search for, talk about Precursor. You could search for a precedent in case law. Like, has anyone ever argued this case and what was the ruling? And that is a precedent, right? So the idea of doing textual search and even Symantec is at a bank or a river bank, like you would think that they wanted to replace all those libraries taking up square footage in Midtown Manhattan, much faster. But it's the biggest graveyard of dead startups known to an experienced investor. There's such a big graveyard with these passionate, educated lawyers that then get into tech and say, I'm going to make this really software driven, efficient, and like automate human workflows that leverage data literally.
Yep.
And yet it comes down to every lawyer is her own little business within Oric.
Yep.
And it's not like Oric or DLA Piper all agree on how they're going to adopt some AI tool.
Yeah.
They basically each do whatever the hell they want. And like, it's really weird. And then you say to a lawyer, can't you make a website that lets me answer a survey of questions and then enter in some inputs, participating preferred, non-participating preferred, whatever, and just liquidation preference 1x, what recommend what is industry standard for based on data. Like, you shouldn't have to pay anything for this. You should just be able to enter. The idea of paying 40 grand or 50 grand for a Series A financing is obscene. And you shouldn't have safes for the reasons that they have them.
Yeah.
And yet, here we are still dealing with it. So what are your thoughts on like the cultural?
I've met a couple of companies. The reason like, as all things, all VC predictions are based on things you've already seen that the rest of the world hasn't seen yet. I've actually met companies that are working with law firms, and it's more on those firms' internal productivity than it is, which will eventually has the potential to translate to cost savings for the customer. Whether it will or it won't, I don't know. But like I've seen tech that can take an NVCA term sheet and spit out definitive docs for a price round really quickly with a high degree of accuracy.
Right.
And more of that stuff's getting digitized between Omni and Ironclad. I think the other thing is like more of these documents exist in digital form with a structure that machines can understand. And I'm super, I just try to follow, like, where do I see talent going? And like, to your point, this is the first time I've actually seen the legal community engaging with these companies, not from a position of wariness, but from a position of, hey, if we don't figure this out, what happens if the answer is like not us?
That's right. Like,
this feels way more existential to the ones I've talked to than anything else. They're like, I can hold out on DocuSign, I can hold out on like that practice management thing. Like everything else, it's like, I don't need to engage with this technology. It's not going to fundamentally change my job. A lot of them are like, this could fundamentally change my job, so we have to at least. Now they might engage with this only to stymie it. I recognize that that's a possibility, but this is the first time I've seen different behavior on the attorney side.
Yeah, well, it's an interesting topic for investors, and it's, you could make a metaphor to any industry. Like, I remember I've written a couple books, and my first book was published by McGraw-Hill, and I'm pretty open. I've had a negative experience with McGraw-Hill, and all my other publishers in other countries I like much more than them. And when blockchain came out, I was like, okay, let's make them honest. I want on the blockchain an API. So every time a book is sold on Amazon or Barnes and Nobles, that gets onto a blockchain and it gets to them at the same time. Make them honest. I literally don't believe them on the number of books produced, burnt, whatever, returned. All this stuff should be no free will of me trusting them. It should be on the blockchain. But I guarantee you, McGraw-Hill will never pay money to some blockchain company to make them honest. And they're like, oh, Andrew, the Chinese are definitely lying to you. I mean, you've probably sold many more books in China than they're telling us. And I'm like, I don't trust you sitting in New York either. But when you say with the legal industry, they don't love the idea of not billing us for X number of hours for doing it, when it was a ChatGPT wrote the thing in a second right before your eyes. But someone else will create a law firm that says, we are leveraging technology. I'm X partner at Wilson Sonsini, and I overlook every document before it goes out. But I'm not a stupid child, and I'm not drafting it with a slide ruler. I'm using technology. So I think it's like someone's got to take down McGraw-Hill. McGraw-Hill will never eat its own babies. Like,
and like when I first met Henry Ward at Carta, I was like, lawyers don't want to get out of the cap table business. Like they make money on this. Like they're never gonna let you do this. And
Well,
in the
there's
beginning,
mistakes in cap tables, yeah.
yeah. And like in the beginning, there was resistance, and then we've gotten to a place where I think, Carta aside, did I expect every company to have a digital cap table somewhere, whether it's with Pulley, Carta, cap table? I expect them to have one.
That's right. I mean, I remember it was called eShares.
eShares, yeah.
It's like I like the name eShares. When that came out, I was like, thank God,
Yeah.
thank God for this. And now, like Fidelity has been sponsoring our events, and they bought Shoebox.
Yep.
And I think I'm like so happy to see like the monopoly of Carta threatened by
Yeah.
a really powerful, that's a multi-trillion-dollar asset company.
Yeah.
That could be really great for us.
Yeah.
Well, Charles, I've actually should have given ourselves more time. I got my next call waiting to come in here, but thank you so much for taking
This was awesome.
time with us. Before we wrap, so where are you in your life cycle without violating any securities laws? When did you close your last fund?
I will only say I no longer consider us an emerging manager. I'll just say that.
Oh, that's great. That's great. I mean, there must be a lot of appetite these days to back you specifically. So you've kind of broken into institutional.
We have, and I think we're very fortunate. Our model runs contrary in many dimensions. Single GP, lots of companies, very early. It's the anti-pattern for a lot of people, and I'm constantly telling our LPs how grateful I am for their support, because it's hard. I can't imagine them. I'm really like, brave is probably too strong of a word, but like I think it takes a lot of courage to take a model like ours to committee at an institution where like the thing you're telling them you want to invest in is the opposite of what many people think works.
Yeah.
And they really stuck by us and supported us, and like I'm super grateful for their support, and I feel like it makes me want to make them a whole lot of money so they can go back to their committee and say, see, we told you this N of one weird anti-pattern fund is like one of our top performers.
Yeah. Well, I'm sure that in competitive environments, startups are taking your check, and at the end of the day, those 54x, 34x, 100x will just deliver the money back in a way that 4 months of vacation and 2 deals a year is just not gonna. Investing with companies at $75 million rounds that you just 2x. At the end of the day, someone's got to pay those police their pensions.
Yeah, I mean, look, we're in the business that makes sense for me. I couldn't imagine investing any other way. I don't think I'd be very good at it. So I'm glad I found my own little lane.
Okay, well, Charles, we should communicate more often to share some deal flow. Thanks so much, and
good to see you.
See you in person soon. Bye for now.
Right. Bye.
Well, that was certainly interesting. It's Mark DiTargiani with Pacific Western Bank back here. Again, really excited to be part of the podcast with 7BC and Andrew. And we're excited just to support the ecosystem and help you get to whatever your next step is in your business journey. Thank you very much.